You're giving up £5,000 to save a few hundred. That's not a tax strategy, that's a donation. And yet, loads of expats jump into the FIG regime like it's a no-brainer. It's not. FIG looks amazing on the surface. Ignore foreign income for 4 years? Less reporting? Sounds like a win until you realize what you're trading away. Every year that you elect in, you lose your personal allowance and your capital gains buffer. For many, that's a £5,000 hit just to play. So the real game is simple. Are you saving more than you're sacrificing? Because most of the time, you're not. Picture this. You've got a rental back home and a bit of interest income. In the UK, that might trigger, £800 in tax. Now compare that to giving up £5,000. That's not clever tax planning. That's overpaying with confidence. This is where people slip. They treat FIG like a 4-year package deal. Tick once and ride it out. Wrong. It's a year-by-year decision, and in low-income years, FIG is usually a terrible deal. But then one big moment changes everything. You cash out KiwiSaver, sell an overseas asset, take a large pension withdrawal. Now you're staring at a potential UK tax bill in the tens of thousands. Suddenly, sacrificing your allowance, irrelevant. That's when FIG shines. One strategic year, massive tax avoided. Same goes if you're earning big in the UK. Once you're over 125k, your personal allowance is already gone, which means the cost of FIG, basically zero. Now stack that with foreign dividends, rental profits, share vesting. At that point, FIG isn't a decision, it's an advantage. But there's another angle most people miss. Complexity. Some foreign income isn't just hard to tax, it's a nightmare. Trust distributions, old investment funds, half-documented estates. You could spend weeks untangling it, pay thousands in fees, and still get challenged. Or you elect FIG, take the allowance hit, and move on. Sometimes you're not buying tax savings, you're buying simplicity. Then there are the hidden levers. Earn more in the UK, FIG gets cheaper. Have income taxed heavily overseas, FIG gets weaker. Capital gains versus rental income, completely different outcomes. Same regime but totally different results. And timing, that's the silent killer. You get 4 years, so do something big in year 4. Great. Do it in year 5 and you're completely exposed. Same decision, wildly different tax bill. And still people treat FIG like a default setting. Tick the box, hope it works out. But the reality is brutally simple. If the tax you save is bigger than what you give up, use it. If it's not, don't. No guesswork, no habits, just numbers. Because for most Kiwis and Aussies with modest foreign income, FIG quietly costs more than it saves. But in the right year, it stops being a choice and starts looking like a 5-figure difference. And the tricky part, knowing which year that actually is, because this isn't a set and forget decision. It shifts with your income, your assets, and your timing. And getting it wrong isn't obvious until after you've already paid for it. That's where having someone run the numbers properly makes all the difference. Not guesses, not rules of thumb, just a clear answer on whether FIG works for you this year or not.